I am pleased to welcome back to the street Marc Chaikin, founder and CEO of Chaikin Analytics. Marc, it's great to see you. Welcome back.
Scott, good to be with you.
You were last here in late January, right before all this volatility, right before the world started it to end, so to speak. What's your reaction to the past couple of months in the market?
Well, I think the market has reverted back to the norm. 2017 was like a bull market, sort of sleepwalking to new highs, and then we've gotten a roller coaster of a correction. So we're back to very volatile times, and it's challenging, but the market is held together. It's bent and not broke from my point of view.
Yeah, we've rebounded slightly from those lows, although we still remain in this sort of narrow trading range in the S&P 500, 2550 to 2670 or so. What gets us out of that range?
Well, what gets us out is to break this pattern of negative closes. It's turning Chaikin money flow, which measures institutional accumulation and distribution, negative. So all these retracement rallies that are trying to break through what we see as resistance 2685 to 2705 are coming with weak closes on balance, and that means that people are selling into the close. They're either afraid of tweets overnight or something out of China. Until we break that pattern, it's going to be very hard to break through resistance. We thought the earnings might do it, but then look what happened to the banks this morning.
Yeah, we had good results from JP Morgan, Citigroup, not so great results from Wells Fargo and PNC, but all the bank stocks got hit, perhaps because of the ETF nature of how stocks trade right now. Would you agree with that?
I would. I think a lot of people bought the financial ETF, the XLF, in anticipation of good earnings. You got great earnings out of JP Morgan and Citi. Wells Fargo actually beat estimates. But the fact that they reversed tells me that we've got a sell on the news mentality. If that's the case, then the market, which looks like it's formed a W-shaped bottom, may go back down, break the 200-day, and cause people a little more pain before we see a move back to the upside.
You say the W-shaped sort of nature of the market, similar to August and September of 2015 and December and February of 2016. Can you explain that dynamic?
Well, any time the market closes more than 10% down from a peak on the S&P 500, you've gone from a pullback to a correction. Typically, over time, you need a W-shaped bottom. So you make a low on very panic selling. We saw that in February. You rally up, come back down, and either test the low or make a lower low in more normal sort of conditions. We've had that. The problem is earnings are going to drive the market to new highs. If we get a sell on the news mentality here in earnings season, which began this morning, it's going to be hard for the market to regroup. Still think the uptrend is intact. And in this volatile climate, you got to be buying weakness. You really can't reach for stocks. So you get a strong opening on JP Morgan, that's not the right time to buy stocks. You want to buy pullbacks in this kind of market climate.
Any idea where we end the year at in the S&P 500?
I'm looking for the somewhere between 2,800 and 3,000. I'm still maintaining a very bullish outlook because the economy is strong and earnings are strong. Now, we've got all these exogenous events, fears of tariff wars, fears of higher interest rates. That'll all play out in the short term. Longer term fundamentals usually win out, so I'm still sticking to a bullish forecast for 2018.
And we can't forget the tax cuts, right? I mean, I think the tariffs deflated some of the excitements from tax cuts, but do you think overall, even if we have tariffs, that the tax cuts will kind of come in and sort of, lessen that negativity from the tariffs?
I don't, because I think the impact of tax cuts has already been factored into the market. Tariffs are a no-win situation. Nobody wins in a trade war. So we've been saying this consistently since the rumors came into the market about that. Trade wars are really bad for the global economy. They're bad for the U.S. consumer. They tend to raise prices, so inflation goes up. If we get a real trade war, and it's looking like we may not, President Trump's already backing off the TPP and now saying, well, if we get a better deal than President Obama did, then we'll go back in. So a lot of his negotiating style is bluster and, bullying comments and then negotiating afterwards. So I think with Larry Kudlow in there, we've got a shot at avoiding a trade war.
We should also talk about tech stocks. When you were last here, none of the issues that the tech sector is dealing with right now were really front and center. Of course, I'm talking about Facebook's data woes, President Trump's tweets on Amazon. Is the notion of tech being a leader in the market, is that gone for right now and in the coming months?
Well, it's certainly been more challenging. I don't think it's over. I think the chip stocks have a lot of rebuilding to do, so Micron, Lam Research, AMAT. But if you look at Intel, you get a really good picture as to whether the tech sector is robust. Intel still looks really good, the biggest semiconductor manufacturer, and obviously, you know, you guys have loved NVIDIA over the last year, and I think there are going to be buying opportunities. But again, you don't have to reach for these. You've got to buy them on weakness. Otherwise, you're not positioned for success in a volatile market, especially in tech.
But we've been seeing NVIDIA shares sort of trade in tandem with cryptocurrency prices. I mean, it seems like that is the wrong mentality to have when thinking about NVIDIA, which is so much more than cryptocurrencies, right? Data centers, autonomous driving.
Exactly, but we did have some problems with autonomous driving, with that death in Arizona. So there's been a sort of perfect storm of negative events. I think NVIDIA is going to weather that storm, and it's just a question of being patient and getting in at the right spot. But you're right, cryptos and NVIDIA are now sort of joined at the hip. That's not good if you're a long-term investor in NVIDIA. Why? Because it creates all this volatility as cryptos are volatile.
So your final piece of advice for investors, especially now that I think we can all agree that volatility is back.
Final advice, volatility is your friend if you have a disciplined game plan. So pick the stocks with solid fundamentals, good balance sheets, buy them on weakness, and let the volatility work for you instead of panicking and letting it work against you.
All right, and then before we go, you're launching a new newsletter, Mastering the Bear, on May 1st.
We believe that there are opportunities to make money on the downside in bull and bear markets. It's a totally new direction for us, and we're very excited. It's an interactive newsletter, so it comes with a market letter and then access to some of our technology at Chaikin Analytics. So we're very excited about that, and we think that investors need to know about how to trade the downside, because inevitably there's going to be a bear market. But even in a bull market, we've seen enormous opportunities on the downside. So we're very excited about this. It's a new direction for us, and we're hoping that this really resonates with traders.
All right, Marc Chaikin, thank you so much for coming in today.
Scott, thank you for having me.